Given that we have seen supportive measures from the government in terms of, for example, putting a floor under the price of oil that they use to calculate retail pricing, are we expecting to see more government support for the oil majors in China, and how does that impact the outlook?
Well, I think that the government has stepped in with this floor in oil prices at $40 a barrel. But beyond cutting taxes further, there's really very little that the government can do. The break even for onshore producers is around $50, $60 a barrel. It's less for offshore, where it's around $30 a barrel. But really, the industry is facing a very, very severe test, given the fallen oil prices, which is really going to put a lot of strain on cash flows and raises a big question around what the oil majors are going to do in terms of capex spending this year.
Right. So, if you continue to see capex cuts, does that kind of help them get through this super low demand period? What are the expectations that we may see a quicker recovery in Chinese demand?
Yeah, well, I think that in terms of the capex cuts that we need to see, we think we need about 30–40% cuts in capex to get free cash flow break-evens down to a level that's sustainable. I think there's a question as to whether or not we'll see that. I think the companies are under a lot of pressure from government to keep spending, to keep employment, certainly in onshore China. So I think the big question is, how big and how deep the cuts will be. In terms of the demand recovery, we are starting to see that. We saw refinery runs collapse really in February, down 30–40%. Over the last few weeks, though, we have started to see an improvement as China gets back to work, with refining runs now down 10–20%. So, I think we are starting to see demand come back as the recovery gets underway, but we're still tracking significantly below where we were in 2019.
So, Neil, who's the most price sensitive among China's oil majors? And who could be the most defensive in that case if you were to go in with a stock?
Yeah, well, CNOOC is the most price sensitive. It's a pure E&P company. 80% of the production is oil related. So it's the most oily E&P, probably globally. And if you want to gain exposure to crude prices, that is the stock to own. But it's also got a defensive quality to it because CNOOC is net cash. It has no debt at all in its balance sheet. And it's one of the global E&Ps that you can be certain of is going to be able to withstand this prolonged oil war that we've come into. In terms of which company is the most defensive, it's Sinopec. So Sinopec is about 70% downstream, and it really benefits from these lower oil prices in terms of lowering the cost of feedstock for petrochemical production, and also the lower crude prices that will help refining once demand comes back. Obviously, in 1Q, we've seen significant 20% decline in demand, but as you see demand come back, once with low oil prices, that will help drive earnings at Sinopec, which I think is the most defensive stock to own.